Welcome back. You're watching First Trades live on ET Now for 60 minutes into trade, and it's been a rather non-inspirational session for Indian markets. We started the day hoping that Indian markets would stay above 5350, but because of two downgrades, poor numbers from Bharti, the fact that we've got a big downgrade on India Bull groups from Veritas, the sentiment is not looking charged up. It's too early to make some kind of an assessment that things have reversed, but for sure momentum which everybody was betting on is not there. But these early days, things can remain volatile, markets can be choppy, and then they can pick up steam in the second half of the trade. So it could be a story of a slow start and a strong closing today. But let's connect with Sean Darby, global head equity strategist with Jeffries, to talk about at global level, even though regulatory action is not all that strong and supportive, what exactly is fueling risk on trade. Sean, good morning. Thank you for joining us. How do you measure global risk? There is a talk of not a depression, but for sure recession in United States of America.
Well, I think most risk indicators are really reflecting, for example, the long end of US bond markets, gilt markets, and German and Japanese government bond markets, and they are suggesting a period of very low growth and, of course, very, very low inflation expectations. So I think that's one of the best indicators. And on the short end, I think you really just have to look in the European two-year notes, particularly in countries like Germany, Netherlands. These notes are all in negative nominal yields, and that again suggesting a very, very risk-averse environment. And in terms of the US recession, well, I think certainly the US Senate will go into recess over the next week or so, and that really means that the issue of the fiscal cliff will become much more prominent post the US election, and whether that can be actually saved for the US economy by some change in the authorities after the US election. Our suspicion is that the fiscal issue will become far more important in the United States over the next month or so as companies refrain from investing and employment. So I would say that we're going to still see weaker US growth, and not necessarily a recession this year, but certainly there's a very, very high chance that we're going to get much, much weaker growth first quarter next year.
So after the ECB chief's comments last week, do you think the situation in Europe has stabilized, or are policymakers just biding time, according to you?
Well, they've certainly bought time over the last 18 months, really, whether it was the Greek elections and also the Greek bailout, and now we've turned ourselves towards the Spanish bailout. And frankly, all they've tried to do is manage each of these bailouts so that the impact on the financial system was mitigated. I think we'll start to see Spain looking for some aid over the next month or so. And already, of course, it's capitulated, given the fact that it's required around 100 billion euros for its banking system. So I don't think it's going to be too long for the Spanish to recognize that it's going to need some formal aid.
Sean, at a time when global growth scare is clearly evident, do you expect some more regulatory action, maybe a QE3 or maybe another round of LTRO?
Well, I think our theory really is that the LTRO probably can happen, but more likely the EFSF or the ESM will be involved in short-term bond buying in Europe. That will keep the yields on Spanish and Italian bonds at far more acceptable levels. For global liquidity, I think we would have to see an outright coordinated monetary policy easing, and I still say that that's quite low in its probability.
So, Sean, turning to India, it's now seeing a drought situation. Will inflation then in the near term become a key concern?
Well, certainly India is facing a very bad failure of its monsoon, and much like the United States, this was not necessarily something that was predicted nearly 4 or 5 months ago. And for the authorities, it's coming at a very difficult time, with the crude oil prices once again rising, and of course the weaker rupee introducing inflation into the economy. So I think the bottom line really for India is that the data points are still going to suggest a very difficult period for monetary operations, and that really does mean that I think inflation is going to continue to rise, and we'll start to also see the rupee continuing to weaken.
Ron, RBI is forecasting a GDP growth of 6.5% for FY13, but do you think for FY13, given the way how monsoon has progressed and the fact that the investment cycle is yet to pick up, India could see a sub 6% print?
Well, as we've seen also with the power cuts and the power failure over the last week in India, I think the numbers in India will still actually be trending downwards. There still doesn't seem to be any cohesive policy towards reform or indeed for actually resuscitating growth within India. And again, I would suggest that the market's going to be disappointed by GDP numbers. There doesn't seem to be the same inertia in the economy as we saw 2 years ago. And as I say, that's largely to blame on the policymakers themselves and government officials.
So, Sean, what would you buy in India at this point? Or is the broad tactical call now a sell for India?
Well, certainly the Indian equity market did very well in the first quarter, and I think a lot of clients really will feel that they've missed an opportunity to come out at those levels. The Indian equity market still held up astonishingly well over the last 6 months, and I still suspect that there's reasonable bid to the Indian equity market from emerging market investors. But in a total return basis, I think you still need to take into account that the rupee is going to weaken and economic numbers are going to still be quite poor. And that suggests that earnings are going to deteriorate in India. And I think we'll still see lows again in the second half of 2012. And that again means that the Indian equity might underperform other benchmarks.
Sean, finally, what are your thoughts on Indian rupee? Do you think closer to 56 we have a floor in place for rupee?
Well, if we look in terms of a very risk-averse environment with high crude oil prices, which is what we've got at the moment, I think it's likely that the rupee will continue to depreciate. If we had a better outcome from Europe over the next quarter, I think you would have, that 55, 56 would actually be a floor. But again, I think the risk for India is much, much bigger than a lot of other emerging markets, given that it runs a current account and fiscal deficit. And I think largely FX markets have become very wary of these type of economies. So I don't see any immediate rebound unless the politicians in India solve the growth equation.
Okay, Sean, good to have you on the show. Appreciate you taking the time out and joining in as always. Back